Max Keiser, this is the Keiser Report. You know, just because we tell you stuff 5 years in advance before it happens, or 4 years, or 3 years, or 6 months, doesn't mean that you actually use that information to your advantage. Some do, but the fact is, we usually tell you what's going to happen years before it does, as in this story, Stacy.
Yes, of course, Max Keiser was right again. Ray Dalio said he would rather own Bitcoin than a bond. Ray Dalio is the manager of Bridgewater Capital, which is the biggest hedge fund in the world, operating out of Connecticut, where he is the #1 taxpayer as well. You said he would find his way to Bitcoin.
That's right. I said he would capitulate. It was guaranteed. And when he started to bash Bitcoin, I said this is a capitulation waiting to happen. It's an interesting statement because he also bashes bonds while simultaneously lauding Bitcoin. So he's another one that's now jumped into the end of the 40-year bull market and bond camp, clearly looking for inflation, clearly looking for bond yields to start going up. That is to say, bond prices going down. And now he understands, as Paul Tudor Jones, his neighbor out there in Greenwich, Connecticut, has said now for a couple of years, if you're trying to get an inflation hedge, the fastest horse in the race is Bitcoin.
Yeah, and that's the remarkable thing. Again, the bond market is something that we've been watching for the entire over 10 years of Keiser Report. It's often it is the widowmaker, right? Because it's in the biggest bull market in history for the last 40 years. And so you have Ray Dalio, biggest hedge fund in the world. You have Paul Tudor Jones. You have Michael Burry. You have Stan Druckenmiller, all in the past year, saying, like, essentially getting to the position where they're shorting U.S. Treasuries, which is remarkable. And this is in response to all the money printing that is going on, that just the historic levels.
Yeah, exactly right. There's an ability of the Fed to monetize that money printing or monetize that debt to a point. And then you get to the end game where confidence in the dollar evaporates and you have a collapse. And so the U.S. dollar is going to go the way of Venezuelan bolivar or other currencies that have suffered hyperinflation. What the price of Bitcoin is telling us right now is that the U.S. dollar is already in a hyperinflationary collapse against Bitcoin, as are all fiat currencies.
So Preston Pysh is looking at this announcement from Ray Dalio that he would rather own Bitcoin than a bond in an inflationary situation, and then now announce that he owns Bitcoin, which is him saying, like, it's time to seek safety. Of course, the issue that we keep on talking about is the price signals and the absence of them, and how the Fed has, claimed they're trying to do good for everybody by destroying the price signals, by massacring the bond vigilantes. So Preston Pysh says, quote, "I'd rather have Bitcoin than a bond." Ray Dalio, sound familiar? CPI is broken, that's Consumer Price Index. QE, quantitative easing, equals asset price inflation. Additional UBI checks, universal basic income, equals even more QE. Because remember, Preston Pysh is the one that pointed that out here on this program. And that he said that the more fiscal stimulus you have to have more QE to balance it out. But also the Fed is buying all of those treasuries, of course, that are the bonds that are being issued in order to feed all the stimulus packages.
Well, as Tom Waits once said, I'd rather have a bottle in front of me than a frontal lobotomy. And that's where the Fed finds itself right now. It's effectively given itself a frontal lobotomy by performing unending quantitative easing, gutting the underlying economic dynamism of the U.S. economy, and now the country is effectively brain dead. Thank you, central bankers. You killed us.
Well, thank you, Fed, and thank you, ECB, of course. Now, of course, you might look at my elegant gold-laced top and think, that looks like something from luxury maker like Louis Vuitton or something like that. Well, you know what? They are in the headlines, and this is, again, Max was right. You pointed this out, and what's his name?
Jimmy Dore.
No. Bernard Arnault.
Bernard Arnault.
He has become the wealthiest man in the world, overtaking Elon Musk, Bill Gates, all those guys. Jeff Bezos, he's now the wealthiest man in the world. But last year, or a few months ago, when Max pointed this out, like Bernard Arnault was only the wealthiest man in France. And, he is the boss at LVMH, which makes all sorts of luxury brands they owned. But like why we knew this was coming, France's richest man gets a free lunch from the ECB. This was back from February 2020, so a little bit over a year ago. And Bernard Arnault, the boss of LVMH, Moet Hennessy Louis Vuitton, exceeded even his own incredibly low yield expectations in his company's giant bond sale this week, which included the biggest corporate issue in euros since 2016. The luxury giant raised 7.5 billion euros, which is $8.3 billion at that time, and 1.5 billion pounds, which was $2 billion at that time, over a range of maturities from 2 to 11 years to help finance his $16 billion purchase of Tiffany and Company.
Right. As we pointed out, that the cost for that acquisition is effectively zero. So the European Central Bank gifted Tiffany's, an American luxury goods maker, jewelry maker, to the richest man in the world.
Yes.
And the fact that it's a luxury brand, like it's Louis Vuitton, et cetera, it's so ironic or iconic in terms of we are right back to the incredible neo-feudal times where the aristocracy is taking bubble baths in, extracted snail urine at $50,000 an ounce made by this guy, Bernard Arnault, who gets hundreds of billions of free money from the central bank to perpetuate neo-feudalism. And just like we had the Enlightenment, we have the new Enlightenment with Bitcoin, and just like we had the American Revolution, the French Revolution, and the Russian Revolution all coming about to end the era of aristocracy a couple of centuries ago, we're getting ready for the new era, the new insurrections, the new revolutions, and Enlightenment and Renaissance 2.0 aided by Bitcoin.
Right. And at the time, February 2020, it's just at the very beginning of the pandemic. It was just hitting China at the time. But again, the article in Bloomberg points out they're like, oh, the ECB couldn't have imagined, you can't imagine that they actually want to help somebody like Bernard Arnault, that it's just for the ordinary people. Really, trust us. Like all these programs are supposed to be just for the ordinary people. Really, we need to help the people.
Right. And when
America.
they did this, I pointed out on this very show that in real time, when it was happening, that it was just the ECB handing over Tiffany's to the richest man in the world now for free, and that's why interest rates are so low. It has absolutely nothing to do with helping out people. As a matter of fact, low interest rates are causing feudalism to reemerge in Europe and in America at the same time. Like, we fought the Revolutionary War for nothing. The Declaration of Independence was for naught. The Constitution's been shredded. We're right back to where we were in 1776. And either this country wakes up and realizes that the central bank, which we resisted for 100 years until 1913, when the Bank of England came over and instituted the central bank, the Federal Reserve Bank in America, and reintroduced aristocracy in America, we are going the way of all feudal serfs into the dirt. Eating dirt, America, eating dirt.
So you said that the ECB gave this Tiffany to him for free. In fact, they paid him to take Tiffany. So it was a double gift. It was definitely in that little blue box wrapped with a $16 billion in free money. And in fact, he got paid to borrow the money. According to this chart, LVMH gets paid to borrow. Its 3-year bond issued last year has moved negative in yield. According to the chart, it's almost certain that a bond of this size will have been bought by the ECB or will be picked at some point in the near future. Often the bank takes up to 20% of eligible issues, and there has been a real paucity of high quality credit since the quantitative easing program kicked back into life.
Right, let him eat Tiffany's, right? This is a real moment in time when the aristocracy gets so arrogant that they pay Louis Vuitton, Bernard Arnault, to buy Tiffany's for a negative cost. And then they wring their hands and clutch their pearls and say, oh, we never intended to do this. And by the way, the kickback that we took, which was hundreds of millions of dollars into our bankers' pockets, and then we went and bought a chateau and a yacht, that was a pure accident. We had no idea how that happened, how printing trillions of dollars and making the most pernicious aristocratic in the world history we've ever seen, it was a complete and utter unforeseen incident, and we don't know what to do about it. Oh, wait, we do. We're going to print more. Shameless.
Wow. So in the second half, we're talking to Michael Pento. In the beginning of, leading into our summer solutions, we're doing a week of summer solutions. This is why I'm wearing my summery shirt. And I just noticed, looking at you from here, you were speaking like an Italian American with a lot with your hands there. So that was quite good. But this is what Ray Dalio at the top of the show, he's, runs the biggest hedge fund in the world. He would rather own Bitcoin than a bond because, by the way, because the ECB, because the Fed are buying up all the bonds and trying to remove your reward for being paid for the risk. You're not being paid for the risk.
Yes.
That's the price signal they're destroying. They're trying to tell you that there is no risk in the economy and destroying the price signal of interest rates. So that's why he says, I would rather own something that's not rigged, not manipulated.
Right. Bitcoin is the bladeless guillotine. Bitcoin is the nonviolent reign of terror that we saw leading up and immediately preceding the French Revolution.
I think it was just after the French
Yes.
Revolution.
Proceeding after.
Proceeding? Okay.
It proceeded after the, not pre, it depends. Prefixes are key in the English language. We're going to take a break, and when we come back, much more coming your way. Hi, I'm Max Keiser. I'm with Stacy Herbert, and we've got a special show here with Michael Pento of pentoport.com. Stacy, what are we talking about?
We're getting ready for the summer solutions coming up in the next week while we travel to Miami. And this is a good time to kind of segue into that. We're here with Michael Pento. He's an investment advisor, has some clients, so he's allocating capital for his clients. And, this is a time that we'd like to look at, how do we allocate capital in a time where price signals are all gone? Max and I have pointed this out. We also have those cycles of the Thucydide strap, for turning, all these things happening. You see chaos out there. So, Michael, first of all, I want to ask you, everyone is expecting this everything bubble to pop. Do you agree that
Everyone is?
Yeah. I keep on hearing it on the news. Everybody's saying catastrophe is coming. Do you agree that there is an everything bubble? And surely if everybody's expecting it, will it pop?
Well, first, let me explain to you how happy I am to have you on the show and not just looking at Maxwell all the time, because you're definitely aesthetically more pleasing in so many ways. But anyway, I digress. Well, and then I hate to just argue with you right off the bat because I'm so happy to be with you, but everybody is waiting for the everything bubble to burst. I don't know. Are you watching CNBC as often as I am? Because, well, I guess if you turn it on for more than a second, you're more than I am. But I do read things from their website, and I hear a pontificator after pontificator explain that this is not a bubble. This is all normal, part of the reopening of the COVID trade, and everything is going to be fine because don't you know the Fed has your back, and they're going to slowly just go back to normal. Normal Fed funds rate, by the way, is 5.25%. They'll slowly go back towards that, maybe a little bit less than 5.25%, and then we'll just sail off into the sunset together in complete nirvana. So I will tell you that that's the opposite of what's going to happen, but most people are not looking for the everything bubble to burst. It is going to burst in dramatic fashion and ruin many people's retirements, unfortunately. Once again, for the third time since the year 2000.
Right. I see the 10-year bond is back at around 1.6. So that scare that yields were rising, they seem to have it under control. The Fed just recently said that, they're not buying that much debt, that much paper out there. They've been consistent at $20 billion a month, as if that's a non-event for them. So they just speak kind of all kinds of gobbledygook out there. The real proof in the pudding seems to be what's happening in inflation, right? So the inflation is more of a barometer of what they're doing. It seems to be has broken out. They're claiming it's transitory. Is that true?
Yeah, it's sure. It's transitory, just like their balance sheet expansion is transitory. It was $700 billion balance sheet in 2007, December 2007, but they're not monetizing debt, Max. It's just $8 trillion balance sheet right now. $8 trillion of Fed confetti. And it used to be 700 billion not too long ago, but they're not monetizing debt. Well, when you monetize debt, which is what they're doing, you create inflation. Now, the inflation used to be withheld, confined within the canyons of Wall Street because we were just monetizing primary dealer debt. And let me have your garbage mortgage-backed security. I'll give you Fed credit, and you buy some bonds and stocks, and you can gamble, and everybody's happy except for the people on Main Street. Well, now we've entered into the realm of helicopter money. So we are not just reliquefying Wall Street, we are sending money directly to people, circumnavigating the banking system. And that means you're going to get an absolute explosion. You're getting an explosion in the broader monetary aggregates. By the way, they're not reporting those any longer on a weekly basis. Remember M3, Max? That went the way of the dodo bird. And now we're not even getting M1 and M2 on a weekly basis. I'm sure in the not too distant future, we'll get a way, the Fed will stop reporting all of these monetary aggregates because it reveals exactly what they're doing. They are counterfeiting your currency to the rate that would make Al Capone blush.
Right. So actually, to gauge the CPI or the inflation number, if you were to use the same calculations they used back in the 1970s, we are right now experiencing the exact same rate of inflation as we did in the 70s that prompted Paul Volcker to raise rates into the teens, up toward 20%. And that's happening right now. So how do they, for example, they used to include house prices. They don't do that anymore. They only go by rent with some kind of other adjusted numbers. But if they don't address the fact that there is runaway inflation at this point, and they keep lying about it, that could cause a serious problem, Michael.
Well, you go back to a commentary I wrote not too long ago about the third or fourth central bank of the United States is coming soon. This latest iteration, which was born in 1913, is soon going to go to the way of the dodo bird too, just like M1, M2, and M3. The first two central banks failed because of the progenitor of speculation and economic instability. Those three central banks went away because America decided that a central bank was a bad idea. And then, of course, we have 1913 till today. But what the Fed has done since really Alan Greenspan in 87 is they've treated every crisis by printing up a bunch of money, taking interest rates to new lower and lower levels, and engendering a whole bunch of new debt and building up asset bubbles. And the reason why it's been successful every iteration since 1987 is because the long-term interest rates fell when the Fed started monetizing debt and when the Treasury started expanding debt by humongous proportions. So long-term borrowing costs fell, which of course encouraged people to take on more debt, and again, solved all of our problems with asset bubbles, reinflating them. But here's the question. Here's what's going through my mind, why I think the central bank is soon going to run out of problems. You can only cause long-term interest rates to fall if the market for your bonds believes that your nation is solvent and that your problem with inflation, to your point, is going to be quiescent. In other words, we are not going to have a large, permanent, protracted, intense battle with inflation. But if the next time we have a crisis, and I predict one will happen next year in 2022, as the Fed drains its balance sheet again, as we end QE $120 billion a month, not 20, 120 billion, 80 billion in treasuries, 40 billion in mortgage-backed securities. As the fiscal cliff hits, and I can go into that at a later time, but when we hit that fiscal and monetary cliff, the stock market falls to pieces, And then the Fed has to come and rescue everything in 2022. But guess what? Our Fed funds rate will be zero at that point. The amount of QE will still be in some proportionality at that point in 2022. So if the Fed has to come back and rescue the market from what was supposed to be a once in 100-year storm, remember 2008, the great financial crisis, was a once in 100-year storm that came about 90 years too early, because 10 years later, they had to go back and lower rates and go back into QE. If they have to go back in there again, I think the long-term bond market has a problem. It's very, very likely because of the lack of confidence in the solvency in the United States and our lack of confidence in the ability of the Fed to keep inflation low.
Right. You know, that brings us to legendary hedge fund billionaire Stan Druckenmiller, who has been all over the news these past few months since the money printing began. It seems to have, sparked some ire inside him. And he mentioned the other day that he lamented the death of the bond vigilante. So explain what the bond vigilante used to be, how the Fed killed it through QE and other interventions. Did they matter at all? And what would it look like today if bond vigilantes had not been killed by the central banks?
I don't think they're dead. I mean, I think the bond vigilantes will someday wake up. Look, I mean, the Fed can print all the money they want. I mean, theoretically, they can print, $1 trillion a day and buy bonds with it. The question is, what bonds are they going to buy? So, Stacy, let's suppose Jerome Powell, we have a problem in 2022, and then the long-term rates start to spike up because they're worried about inflation or they're worried about the solvency of the United States. And then Jerome Powell says, hey, don't worry about inflation becoming a problem because I'll monetize every single treasury bond that's issued. Everyone you'll sell to me, Wall Street, I'll take that. But then you have to ask yourself this question. Are they going to buy mortgage-backed securities too in an unlimited fashion? Are they going to buy municipal bonds in an unlimited fashion? I mean, to what extent are they going to limit their purchases of fixed income? I mean, I guess in theory, they can buy every single bond in the world, but what about utilities? What about stocks? Are we going to hyperinflate like Venezuela, Argentina, Hungary? So there is some limit. And the only reason why the bond vigilantes have been quiescent is because every time the Fed has come in these emergency operations, they've been successful in keeping the long end of the bond market from spiking lower and interest rates going higher. They've been successful. And I contend that functionality will end soon if we continue these iterations of borrowing trillions upon trillions of dollars and having most, if not all of them, monetized by the Fed in rapid succession. You are going to lose the faith of the private sector completely in the dollar and, most importantly, in treasury bonds and sovereign debt.
So speaking of bond vigilantes, it looks like Michael Burry, of The Big Short story back in the subprime crisis, you talked about 2008, he profited by going short. And he has come out and said he's actually going to start shorting U.S. Treasury bonds. He's going to take on the mantle of a bond vigilante. He's going to try to speculatively attack the central bank. Because the thing about it, and we saw this in Weimar, Germany, we also saw with George Soros in 1993, if the interest rates are so low and you have guys like Michael Burry and others that can borrow an unlimited amount, just like the Fed can print an unlimited amount, they can borrow an unlimited amount. And if they can attack the central bank by shorting those bonds, that seems to be his plan. He's serious about it. He's a serious guy. Does he have a chance to succeed?
He could be very successful. I do think it's going to take one more economic crisis before that's the case. Like I said, in 2022, if we do have a recession caused by what they're always caused by is the Fed having the hubris to believe that they've solved some problem in the economy, namely asset bubbles, debt, and artificial interest rates, by taking rates even more into artificial territory, building asset bubbles to even greater proportionality, and then making, corporate debt in the United States, for example, 50% of GDP, phony GDP, by the way, but 50% of GDP, the tightest spreads, junk bonds to treasuries, the tightest in history. a record amount of corporate debt, especially of the jump variety. Triple C debt is trading lower at a lower yield today than treasury bonds are supposed to trade at historically. So you're going to have another crisis in 2022 if the Fed has to come in and bail out the whole system, and the Treasury has to come in and not do a TARP program of $700 billion, not do $6 trillion like we did from March of 20 to March of 21, maybe 10 or $15 trillion. That's all going to be purchased by the Federal Reserve. Yes, you very well may have a problem, just like Weimar Germany did. And I'm sure that central bank said, hey, we can control long-term rates. We'll just keep buying bonds, sovereign debt. But that didn't work because yields in Weimar Germany were not. They were anything but quiescent.
All right, well, that's going to do it for this edition of the Keiser Report with me, Max Keiser, and Stacy Herbert. I'd like to thank our guest, Michael Pento of pentoport.com. Until next time, bye, y'all.